What's up everybody, I am Jaspreet Singh, and if you own a home and you're trying to figure out what do I do with my extra cash? Should I save it? Should I put my money in the market? Or should I use my extra cash to pay down the mortgage on my home? Well, in this video what I'm going to do is I'm going to break down what is the best investment for you depending on what your goals are, and financially what is the best thing for you to do if you should pay down your home, because there are some benefits to paying down your home and there are also some cons to paying down your home. So let's dive right into it. The first thing that you want to understand is kind of where in the home ownership cycle that you're in, because when you go and get a mortgage, let's assume that you get a 30-year fixed rate mortgage, your mortgages are front loaded, meaning that your payments that you're making in the early part of your mortgage are going primarily into the bank's pockets in terms of interest and their profits, and you have a teeny tiny little bit going to pay off your actual principal, meaning the home balance on your loan. And so what happens is for the first half of your mortgage, the first almost 15 years or so, you have more of your monthly payment going into your bank's pockets for interest than actual paying down your principal. Let me actually dive a little bit deeper and show you. I'm on banker.com. You can try this out for yourself, but I put a loan amount of $500,000 at a 30-year loan term at a 6% interest rate, and I'm going to assume that the loan starts on January 2023. That way it's easy for calculations. And if you just look at this chart, what you'll see is this dark blue line shows the amount of money that you're paying in principal, and the light blue line is the interest. And if you start the mortgage in 2023, it isn't until, where is this, October of 2036 until more of your payment is going towards your principal balance rather than your interest paid. Now, it goes a little bit more interesting if you go into this next tab, which is the schedule. And what you'll see here is that in 2023, in the 12 months of you paying your mortgage of about $3,000 a month, only $5,600 is going to pay down your principal balance, while $27,361 is going directly into your bank's pocket of interest, meaning you paid over $32,000 over the course of 2023, and only $5,600 went to actually pay down the balance of your home. Now, while this information might not be a determining factor of whether or not you should pay down your home or not, it might give you a little bit of a fire under your butt to realize that, oh my God, a lot of my money is going directly into my banker's pocket, and if I do pay down my home faster, well, then I can help build my equity in my home without just making my banker so rich. Because if you pay down your home faster, you have less interest going into your banker's pocket. But now the question is, what happens now if I invest my money instead? Well, yeah, maybe I'm still putting my money in my banker's pocket, but if I can put more money into my pocket by investing my money myself, then it's worth it. Because if I have to put $10,000 into my banker's pocket in terms of interest, but I can make $20,000 from my investing, well, I can just take 10 grand from my investing profits, give it to the bank, and still have $10,000 left for myself, so you end up a winner. So the question is now, can you get a better return on your money by not investing your money into paying down your mortgage and investing your money in yourself? Now, the calculation here is relatively straightforward. If the interest rate from your home is less than the interest rate from your investment, then it makes sense for you to invest your money, get a better return, and then use your profits to pay down your home mortgage, because now you can do it at a profit, because now, yeah, you're paying interest to your banker, but you're making more money from investments. The problem here is that here, investing your money also comes with the R word, which is risk. Because while the average stock market return is 10% a year historically, and the average real estate return is also right around 10% a year, that doesn't mean that the stock market and the real estate market are guaranteed to go up by 10% every single year. It's an average, meaning some years the markets go down, some years they go up higher than 10% a year, and if you look at it over the long term, you're making 10% a year. But if you don't have that sort of investing experience, you might not see that same 10% return. Maybe you get a lower return. And this is where that risk factors in, because you can also lose your money by investing your money. So if you're losing money by investing your money, but you could have gotten a guaranteed return by paying off your mortgage, well, then you're losing. Because when you pay off your home, it is a guaranteed return. If you're paying 5% a year on your mortgage, or 6% a year, or 4%, it doesn't really matter what you're paying, and you pay off your mortgage 1 year early, well, that's a guaranteed return on your money, versus here, there's no guarantee. However, here, you could potentially get higher returns, but it's not guaranteed. Now the question is, how do you find the right answer for you? And this is going to depend now more on your financial goals and on your risk tolerance. Because if your financial goals are, I just want to be free, I don't want to have to worry about money, I don't want to have to stress about money, I want to live small, I just want to be able to live my life and never have to think about money again, well, you don't have to take on a whole bunch of risk then. Because if you can pay off your home quicker, well, now the biggest expense that you probably have is going to be paid off, and now you only have to worry about your property taxes, and you don't have to worry about paying a mortgage ever again. If on the other side you say, I don't really care about risk. I want to live bigger, I want to live large, I want to live lavish, I want to have all the nice things, I want to have all the nice stuff, well then you got to be willing to take on more risk. And if you want to take on more risk, that means maybe it's better for you to invest this difference, invest the extra money instead of paying down your mortgage, because paying down your mortgage might give you a 3 to 4 to 5, maybe 6% return on your money if you pay it off early. But if you invest your money, there's a lot more potential return there. And now you can try to get better returns, try to earn more money. That way, now you have more money to pay down this. Now, of course, is it riskier? Yes, but now you have to understand that the risk needs to match your goals. Because if you say, I want to live large, I want to have all these nice things, but I don't want to take on any risk, well, now you're speaking out of both sides of your mouth. You want to have the nice stuff, but you're not willing to put in the work or take the risk to do that. And so you have to understand kind of where it is in your life that you want to be and what your goals are, because that's going to dictate what you do next. Now, one thing that I do want to point out here is if you have other sorts of debt, things like credit card debt, things like your home equity lines of credit, these are higher interest rate debts, then it would be more beneficial for you to pay that off instead of just paying off your mortgage, because when you're paying off your 16% interest rate credit card, well, that's a guaranteed 16% return on your money. Here, when you invest your money in stocks or real estate, the average return is 10% a year. But when you're paying 16% to your credit card company, that is a guaranteed 16% return for your credit card company, but you're the one that's paying that. So it's more beneficial for you to pay off these high interest rate debts instead of investing your money and instead of paying off your home, because your home mortgage, I'm assuming now, is under 16% a year. If you have a mortgage that's costing you more than 16%, we have a problem, and we got to talk about something else here. But if you have a normal mortgage rate, this is where you have to understand what are the bigger debts, and you want to be paying off that credit card debt as fast as possible. Now, the counter argument could potentially be, but Jaspreet, we're talking about the home that I live in. If I don't pay off my home, well then I could risk potentially losing my home if I don't make my home payments. But my credit card, I could just declare bankruptcy on. Now, if you don't have the money to make the minimum payments on your home or your credit card, this is where you need to get an advisor ASAP. That way you can figure out what you need to do, whether it's an attorney or an accountant, because now you want to make sure that you can take care of your family and your finances, and you need to know what your options are ASAP, because yeah, you don't want to lose your home, and you also don't want to get defaulted on by a credit card company. So that is a different situation. But if we're talking about the general now, if you have extra cash, do you put that money towards your credit card or towards your home? Put that money towards your credit card, pay the high interest rate off, and now we can talk about home versus an investment. And the answer here, yeah, is the return that you can get, but secondly is the lifestyle that you want to live. Now, if you do want to make that decision that you want to pay off your home early because you don't want to ever have to stress about payments again, because nobody likes making payments. I hate making payments. If you don't like the idea of making payments and you want to pay off your home early, great. Now, what you have to understand next is that when you make your extra payment to your bank, to your lender, you want to make sure that the extra money that you're putting towards your mortgage is being applied to your principal balance, and it's not being used to pay off your next month or your next payment for your loan balance, because these two things are going to give you two completely different results. Because if you use your extra money, if you have an extra $5,000, for example, and you use this money to pay off your next month's balance or your next balances, well, now what's happening is you're just prepaying your next month's bill, and then the next payment you make is just going to be going towards the following month, which means that this $5,000 that you're paying is going to be going partially into the bank's pocket and partially to pay down the principal balance. And instead, what you want to have happen is all $5,000 that you're investing back into paying down your home is going towards paying down your principal balance, and none of it going into the bank's pocket. So, if you're going to pay down your home early and you're sending in some extra money to the bank, make sure you do it as a separate payment, and make sure it is clear that this money that you're giving to the bank, to the lender, is going to pay down the principal balance entirely, and none of it is going to interest. So if you're paying it online, there should be an option there. If you're sending in a check, make sure you send it in as a separate check. Talk to the lender, talk to them, make a note, let them know that you want all of this money going directly towards your principal balance, and it's not going to interest. I can't emphasize this enough because it will make a big difference in how much money you pay overall, and you want to bring down the principal balance as fast as possible, because as soon as the principal balance starts to go down, the amount of interest that you'll be paying will also go down. So it'll save you more money over the long run as long as you are paying down your principal balance faster. Now, if your question here is, okay, I kind of like the idea of both. Maybe you put some money towards paying down your home faster, but you also want to invest your money. This is where now the more financially educated you are, the better returns that you can get. And this is where now you can build real wealth, because now you're building equity, you're building investments, you're building assets that can pay you, and now you own these assets which are now paying for your lifestyle. But this requires you to have the right financial education. Now, if you're looking for an easy way to start learning, we have a free guide on passive income that you can read, which will go over how do you invest your money even if you don't have a lot of money, how can you start generating passive income, how do you put your money to work. So if you want to read this guide, it is completely free, and I'll put the link to how you can download this passive income, passive investing guide down in the description below. But this is where now you have to understand the different ways that you can invest your money. And I'm just going to start by talking about me, because it might help you understand the different options that you have, because there are 5 places that I invest my money. I invest my money into my own business and startups. So I have a company called Market Briefs, and I invest my capital, my cash, into this company because I want to build this into a bigger financial media company. Second, I invest my money into real estate. I talked about in previous videos how I invest my money into real estate for cash flow, where now I'm gonna buy houses, single family homes, I buy apartment complexes, not for the purpose for me to live in myself, but for me to rent out to other people. That way now it's providing me consistent cash flow. I also invest my money into stocks. So now I'm investing my money into individual companies. I'm investing my money into ETFs, which are funds, which will now I buy for appreciation because I believe in the economy. I believe in the long-term health. I believe in the long-term growth of the economy, and I want a piece of that. The stock market allows me to do that. Fourth, I invest my money into cryptocurrency. I look at cryptocurrency less as a meme opportunity just to try to flip things and make a quick profit. I look at it as the future of money, the future of property, and the future of technology. I think there's a lot of value in the blockchain and the things that it can do, and I look at it as a software. So I invest in it for that purpose. And I also invest in physical gold, which is the 5th place I invest my money. And when I invest in physical gold, I'm not really trying to get a return on my money per se. I'm investing in physical gold as an alternative to saving money, because the physical gold provides a better store of value than my cash does, because cash can be printed. You can create more inflation, which dilutes the value of cash, versus gold has to be mined. It takes time, effort, and labor to mine a physical ounce of gold. And so I know that this gold isn't producing more value, but for me, it's a better hedge against inflation, and it's kind of like insurance against the worst case scenario. So those are the different ways that I invest my money. And now this is where you can start to understand there are many different ways for you to invest. It's not just putting your money into ETFs. It's not just putting your money into the market. There are a lot of different ways for you to invest, and each different investment opportunity can provide different returns depending on which phase of the market cycle that you're in. Now, I'm not a trader, I'm a long-term investor, and I understand that some of these asset classes will do better in certain economic cycles than others. But I also understand that it took me a long time to understand how to invest my money. It took me a lot of mistakes. It took me a lot of years. It took me a lot of books. It took me a lot of education. I took a lot of courses. And this is where, if you're just getting started, you want to start investing in your own education. This could be reading books, taking classes, but then also the experience, because you cannot just ignore this experience. That experience is the best teacher. Making mistakes is one of the best things that you can do, because you're going to learn very quickly when you lose your own money. And when you lose your own money, you're going to want to learn how you never do that again. So it's going to put some fire on you to learn how to invest your money better. But this is where now understanding the different ways that you can invest your money and start educating yourself, whether it's through books, YouTube videos, podcasts, classes, or actual education by doing it yourself. It's about putting in the education and putting in the reps by learning. That way now, as you become a better investor, it's much easier for you to get better returns, because now you're better educated and you can find the opportunities a whole lot easier. If you're talking about real generational wealth, this is the way that it's done. And I'm just talking about building a system that is foolproof, and the way that you can do that is you need an income stream. That way now you're not worried about pulling out all of your principal while you're alive. You want to be living off of the cash flow, the income, the dividends, or the royalties.